So getting back on the subject of William Jennings Bryan, he was somebody, right, in 1896 who
Right.
was foregoing to bimetallism, right, gold standard and silver standard, and advocating for inflation for the farmers. How much do you think he was instrumental in creating, the process of creating the Fed and the meeting of Jekyll Island in 1910? Like, how much do you think his sentiment influenced the public to...
So I can't say too much about his role in the Fed, but I do think that sentiment is a very common thing in politics. The idea of sort of easy money, going to help some people, makes it easy, low rates, easy to borrow. It's emphasizing one side of the market quite a bit. The inflation we saw in the 70s, to some extent, the high inflation would be good for people, lower unemployment. We can't have disinflation, it's going to be very harmful to people. So that's similar to the cross of gold, right? It's popular, you're appealing to haves versus have-nots, right? It's a have versus have-not story. And so I think that's still there. And I think it's not correct. I think it's basically the better policy is better for that crisis we had in the great financial crisis. To some extent, it occurred because rates were too low for too long, as I see it. And the reasons for that, to some extent, was, well, we're afraid to raise rates. It's risky to raise rates. And the mechanism may have been related to that. So I think it's a common feature of policy, which William Jennings Bryan said it more explicitly than others, but I think it's still there. A question here? Yeah, back.
Thanks. Is there a period when central banks have set rates too high according to the rule?
Yeah, I think probably the most thing we argue about is the European Central Bank setting rates too high in, was it 2013 or 14, perhaps for that reason, that period. There are periods in the 90s where maybe it looked like it was getting too high. I think it's most often, it's a good question, most often it's too low. In recent history, it's been too low. And that's true of Turkey, for sure. It's been true of Argentina until recently. And it's so if you look around the world, I think you see a pretty close correlation to that it's frequently below the rule is the problem. And it may be this kind of argument that I'll put it this way. If you talk to most people, they would say, low interest rates are just good. You can hear that all the time. Low interest rates are good. Well, they're good if you're borrowing. They're not so good if you're saving. So it's like any kind of price. It's two sides of the market. And people tend to think about one side of the market too much. So it's a good question. The errors are more frequently in that. So that's why we've had generally inflation. And then recently, the problem in the US has not been so much inflation, it's been the terrible recession, the slow recovery. So there's other factors that can get in the way of interest rates being off track. Over here, go to the other side for a second, Barry.
Hi, thank you for coming to speak to us. I was wondering what you thought about raising the inflation target or even replacing it with price level targeting or nominal GDP targeting.
So the question is, should the Fed or other central banks raise the inflation target? So that's discussed quite a bit. And one of the reasons it's discussed is they think, those who are proposing it think it will reduce the chances of hitting the zero bound. So in the Taylor rule, the inflation rate is 2%. If the real rate is 2%, that's a 4% average. So there seems to be not as much room to go down to zero. But if your inflation target was 4%, and 4 plus 2 is 6, your average would be 6, so there'd be more room to come down. So that's probably the biggest argument that's made now for raising the target inflation rate. I don't think it's a good idea. I think there's enough room. There's been enough room. It'll work quite well in the 80s and 90s. And plus, there's a huge credibility issue. If central banks try to go to 4, is it, wait, what happened? I thought you were concerned about inflation. You think 4 is okay. 2 is already, by many people's view, too high, right? Why should it be 2? Plus, and this is something that I guess I would think about, they've been having trouble getting to 2, right? It's just coming up. And now they're going to say 4? What's that going to imply about interest rates down. So I'm not a fan, but that's the legitimate argument that people made. Right here, front row.
Hello. I was just wondering how you feel your proposal can actually be practically implemented, given that a number of central banks around the world, the Chinese one being one of the most significant examples, make decisions that are at best with very limited independence from political institutions.
So as I understand the question is, the proposal I have is that each central bank would have a policy rule. It would look mostly at its own situation when it does that, and wouldn't so much look at what the Fed does, it'd look at what Switzerland does or something. So it's a very good question. Why should that work is the question. Why should it work that each central bank basically does what's best for its country? It's responsible for. It says it's strategy, but you say, why should that be good when in fact the whole world's connected? Shouldn't you have the ECB and the Fed be working together? So that is a very important question. And I say the answer is, what I've found and others, is that it's pretty close to optimal for each central bank to do their own thing. It's not perfect, because you, in principle, almost any model you have, you're going to say you do a little bit better if you coordinate. But it's very close to this optimum where their countries are coordinating explicitly. And the beauty of that is it's hard to get countries to coordinate this way, and it almost always causes problems. So if you can have a world where the Fed, Bank of Mexico, the Central Bank, the People's Bank of China, does their things for their own country in a way it's like a policy rule, but they communicate it transparently, that works very well. And it seems to me that's sort of the ideal situation. It makes coordination easy. You just do what you think is best for yourself, but communicate. And so that's the idea. It's a very good question. I didn't explain all that, but I hope this helps. Okay. Right here, yeah.
Thank you for coming to speak to us today, Professor Taylor. Two quick questions. One is that the idea behind rules seems to be predicated off of expectation formation. So say that we find that expectations aren't full information, rational expectations, and we have, for example, rationally inattentive actors, or expectation formation happens in a different way. How does that affect the argument for or against policy, monetary policy rules? And the second question is, which couple of papers provide the biggest challenge to your point of view, and why?
So, what's the first part again? No, just quick. I'm thinking of all the references. So the question is, it looks like the rationale I'm giving for policy rules is based on a particular way to think about the future, sometimes called rational expectations, so that people are forecasting the future in a rational way. And I'd say I don't think that's true. In fact, it's very important in economics, I think more generally, to have the ideas robust to different ways of thinking. We don't know which is correct, I'm embarrassed to say as an economist. Rational expectations is one helpful way to think about it. It at least makes people somewhat savvy about the future. But there's other behavioral economics. There's other things, or rules of thumb. And so you want to have, whatever you're proposing in practice, I think it has to be robust to those things. I've always argued for that. So to some extent, that's your answer. And I believe most of the things that I've said here, or people have written in favor of rules, are thinking more robustly about this. But I'm not saying that in one paper, in Econometrica, there could be one model and they say it's good, and that's a very artificial model. So, well, articles written on the other side, I think I've referenced some in the pieces I said you should read, but I think one of the most, actually, you should probably read some Ben Bernanke stuff. Ben Bernanke has written quite critical of rules. He always has been critical of rules. So maybe read some of his things recently would be the best to do. Janet Yellen is more in favor of rules, and she's written a lot on that, so maybe contrary. There are two leaders of the Federal Reserve who've had different views about it. Okay. I have to go this side once, yeah.
So I think this comes back to the idea of rules versus discretion, but economics seems to be a subject that balances being like a very empirical driven study, but also is politicized and kind of has subjectivity to it. So do you think economics should be practiced as more of an art or as a science or somewhere in the happy medium place?
So I think that economics involves data, the real world, it involves theory, and it's back and forth. I could not possibly say one versus the other. For me personally, the motivation on the policy side has been very important. I don't have the inclination just to do the theory personally, but other people do, and I think it's terrific. It's a beautiful subject and has applications we don't always know about what they'll be. So I think that back and forth is really important. And actually, one of the more exciting things about economics is they're getting more and more data that we can use. You know, big data, huge data sets, you're testing the theory. I have a kind of a hope that will deliver better policy, better monetary policy in particular. And there's already things happening. Just as an example, when the Fed implements policy rules in the past, anytime, they have to know where we are. So we're in the third quarter. We have no idea what the third quarter numbers are yet. So until a week or so ago, we didn't know the second quarter. And so there's a new technique designed called nowcasting, which the Atlanta Fed is doing a lot on this. And nowcasting is using big data to figure out better where you are. And I tell you, the best way to forecast is to know where you are. And so that's an example where we're improving. And I think there's other things that could be done on that dimension, a lot more market data to be used. So that's how I think about that. We have to worry about the time. Maybe right here, front. Yeah.
Thank you, Professor. So you said after 2003, the Fed acted discretionary, but somewhere I heard that Bernanke also claimed that they did a rule, but with different numbers than Taylor rule, and they matched the data very good.
So I think what you're saying is there's, let me put words in your mouth. The chart I showed you before had the interest rate from Bloomberg News, I think, had the interest rate at 2% back in 2013 or 14. So people will say, that is crazy. How could you possibly have a 2% interest rate? The economy would have fallen apart. And so that is out there. So that's an example of being critical of a rule like that. How could you have zero is much better? Well, I question that. How do you know it would be much better? Yes, you'd have investment would be different, but the markets might be working better, savings might be better, so there's other things that would come into play. So you have history and models. But it's very true that almost any rule you have or propose, people can use it in different ways. That happens to me all the time. I'll read something people call the Taylor rule. It's not the Taylor rule at all, but what am I going to do? And so it's the nature of discourse. In fact, just maybe add, I think we're moving into a era where this extreme viewpoints are more and more the case, sort of attacks or big partisanship, sometimes polarization, sometimes called. I notice that a lot, and I'm not sure where it's all coming from, but it's something to watch out for when you're studying. Try to think which is the real arguments, which are people just calling each other names. So it's a very good question, and I see it a lot, but I don't always know the reasons.
Given that the Fed is filled with like lifers like Ben Bernanke, is there value in constraining them to not having countercyclical policy remedies? Especially like, Henry Paulson talks in his memoirs about like feeling like he puts on a cape in the morning during the recession. Is there value in giving them only the option to target price stability?
Yeah, I think there's a value to having especially an independent agency of government, which we haven't focused on that much. That independent agency of government should have a limited purpose. In a democracy, you have, say, credit allocation is decided by the Congress, depending on various factors. Credit allocation about who gets money, who doesn't, whether it should be mortgages or whatever. I don't think that should be the responsibility of independent agency. The Fed has done a lot of those things. It's sort of moving away from it, which I think is good. But if you look around the world, I mean, the Bank of Japan is buying not only private bonds, they're buying private equity. So that's going way beyond sort of a limited purpose. So I think it's a real concern, and these are, in one degree or another, independent agencies. And to preserve that idea, which I think is important, you can't have them doing everything. Moreover, I think there's a lot of evidence that hasn't worked very well. And the argument in 2003, 4, and 5 for rates being so low, that was to some extent to help certain sectors. So it wasn't, we don't know all the reasons they made that decision. So I think it's good, and I don't want to say you confine them completely, because they are people who are supposed to know what they're doing, they're trained, but they have to be within certain constraints. I think that's one of the purposes of rules. People who study the subject think that a lot. There's a huge debate in economics, rules versus discretion. It gets into that. And rules tends to be more, a rule of law approach to things. Rule of law and rules kind of go together, so that's becomes a more political thing. Again, to me, I've always been interested in rules, but just because I think they work better. It's not really much to do with the rule of law, but that's an important factor as well. Okay, right here.
So you stated that the Fed has only been more recently communicative about its discretionary strategy. Is there any data that the Fed has access to and consults regularly that the public or economists in the academic sector might not have access to?
This is for the rules versus discretion, or more general?
Is there any data that the Fed has access to and consults?
So I think the one chart I showed you, which is not widely known, is by David Papel and his colleagues at the University of Houston, where they looked at periods, rules and not rules, and saw which works better. There's work like that going on in individual countries, but that's what I would point to at the start. The general question of what policy works better is very difficult because so many other things change at the same time. So you had different fiscal policy, different regulatory policies. So I think it makes it always hard to test one theory like this or another, especially in macro.
Discretionary strategy, is there any specific sort of data that the Fed has access to not available to the public?
Oh, I would say probably not. So just to be sure, are you asking, does the Fed have information that makes discretionary policy better because it has it, we don't?
Not privy to the public in general.
So I would say basically not. I mean, obviously they have, because they're a regulator, they have information about particular firms, and that may be a signal of which firms are doing better or not, but if that's helpful for the whole economy. But the Fed's forecasting is sort of average in terms of what they come up with. It's not rocket science. They have made lots of mistakes over time. So I would not hold that out as particularly important. I mean, they do have, they do know the decision before anybody else, and there is some evidence that somehow that has leaked out beforehand and has affected markets. And so but that's not a good, seems to me. That's a bad, because certain people are taking advantage of the information that they know in advance. But that's information about their own decisions. The other thing, maybe briefly about this, another big part of financial markets policy is, what do you do when a firm is in trouble? What do you do when a firm is going bankrupt? For most parts of the economy, we have a bankruptcy code in the US, and they go through chapter 14 and chapter 12. Well, we don't have a similar thing for large financial firms. And so if you had a way for even a large financial firm like AIG could go through a bankruptcy in a smooth way, then that would remove a lot of the special things that central banks, the Fed, think that they can do. So I haven't talked about that here, but it's an important aspect of monetary policy as well. I have one more in the yellow shirt. Yellow jacket, I guess.
Professor Taylor, since fiscal policy affects GDP, including growth, deficit, and debt, that is a part of money supply. equation. How should monetary policy be coordinated with fiscal policy to implement a price stability?
So I think the first thing is to get monetary policy right. So stick to the rule. If it's money growth, stick to that. The fiscal policy can make that more difficult in certain circumstances. Take the U.S. You're going to hear in a day or two from John Cogan, who's going to give you a description of fiscal policy in the U.S. And it's basically our debt is getting very high. And if the debt is getting very high, interest on the debt is getting very high. So that in principle affects the decisions that the central bank makes because they're affecting the interest rate. So it could come back and be another factor that's in their head about what to do. And that is a coordination, and I think in a not so good way, but that can happen. And then if you look at countries, Zimbabwe, Argentina, that have had real, Venezuela, who've had their trouble, it's basically fiscal based. They're just borrowing too much, and the central bank is validating that. So I guess we stop. Thank you. Okay.